There is a three-digit number attached to your name right now. You didn't choose it, you can barely see it. And yet that number quietly decides whether a bank will lend you money for a home, whether a landlord will rent to you, sometimes even whether an employer will hire you. It's your credit score. And almost everything most people believe about it is wrong. Here's how it actually works. Most people assume a credit score is just a measure of how much debt you have. More debt, worse score. Zero debt, perfect score. That logic feels right. It is almost completely wrong. A credit score is not a measure of how much you owe. It is a prediction. Specifically, how likely are you to pay back a loan on time? That is the only question the score is trying to answer. The score is built from your credit report, a running record of every loan, card, and repayment you have ever made. And from that history, a number is calculated. Somewhere between 300 and 850 in systems like FICO. Other countries use different ranges. Malaysia runs 300 to 852. Singapore 1,000 to 2,000. The ranges differ. The logic underneath is identical everywhere. For most of human history, deciding whether to lend someone money was entirely personal. A banker knew you. Your reputation in town was your credit. Move to a new city and that reputation evaporated. You were invisible. Then in the 1950s, engineers at a company called Fair Isaac Corporation had an idea. What if you could strip out the banker's gut feeling and replace it with pure maths? Feed every lender the same standardized score, and lending decisions become faster, cheaper, and less biased. By the 1990s, Fannie Mae and Freddie Mac required FICO scores for every mortgage. The modern credit score was now universal. So what actually goes into your score? Think of it as a report card with 5 subjects. Subject 1. Payment history. This is the biggest one, about 35% of your score. Every time you paid on time, a green tick. Every time you were late or missed entirely, a red mark that sits on your record for up to 7 years. This is the single most important thing you can do for your score. Pay on time every single time. Subject 2. Credit utilization. About 30% of your score. This measures how much of your available credit you are actually using. If your total limit is $10,000 and you owe $9,500, your utilization is 95%. Lenders see that and think, this person is running right at the edge. The rule of thumb, keep your utilization below 30%. Below 10% is even better. Subject 3. Length of credit history. About 15% of your score. The longer your oldest account has been open, the better. It shows you can manage credit for the long haul. This is why closing your oldest card is almost always a mistake. Subject 4. Credit mix. About 10% of your score. Lenders like to see that you can handle different kinds of credit. A card, a car loan, a student loan. Not the biggest factor and not a reason to take on debt you don't need. Subject 5. New credit. About 10% of your score. Every time you apply for a new card or loan, the lender does a hard inquiry. They formally check your file. Each hard inquiry nudges your score down slightly and stays on your record for 2 years. Apply for several cards in a short window and lenders get nervous. It looks desperate. Put the 5 subjects together and you get a simple picture. Payment history is the maths test. Miss it and you fail the year. Utilization is how full your backpack is. Stuff to the brim looks bad. History is your attendance record. Showing up reliably for years earns respect. Mix is your choice of electives. A bit of variety looks rounded, and new credit is arriving on the first day of school. Do it too often and the teacher starts asking questions. So what does the actual number mean in practice? Scores typically fall into bands. Poor, that roughly below 580. Lenders see you as high risk. Loans are expensive or unavailable. Fair, 580 to 669. You can borrow, but you pay more than someone with a better score. Good, 670 to 739. You are in reasonable shape. Most lenders are comfortable. Very good, 740 to 799. You are getting better rates and better terms. Exceptional, 800 and above. You are in the best tier. Lenders compete for you. Here is the part that surprises most people. Moving from poor to good does not just open doors, it physically saves you tens of thousands of dollars on a mortgage because better scores get lower interest rates. Before we go further, there is one distinction almost no one explains clearly. There are two types of credit checks: soft inquiries and hard inquiries. A soft inquiry is when you check your own score, or a company pre-screens you for an offer. Soft inquiries are completely invisible to lenders. They have zero effect on your score. A hard inquiry is when a lender formally checks your file because you applied for credit. That one leaves a mark. Small, but real. And every lender can see it. The practical implication: check your own score freely. It costs you nothing. Every person should be doing this, but be thoughtful before you let anyone else run a hard pull. Now, myths, because this topic is absolutely buried in them. Myth 1. You need to carry a balance on your credit card to build your score. This one will not die. You hear it everywhere. It is completely false. What builds your score is using credit and paying it back on time, not carrying it forward. Carrying a balance does not signal responsibility. It signals you ran out of money. Worse, it costs you interest. Every cent you carry forward is money the bank takes for free. Myth 2. Checking your own credit score will lower it. This fear keeps millions of people flying blind. It is also completely false. Checking your own score is a soft inquiry. It leaves no mark. Check it monthly if you want. Myth 3. Closing a credit card you don't use improves your score. Feels tidy, almost always backfires. Closing a card instantly removes its available credit from your utilization calculation. Your utilization spikes. Your score drops. The opposite of what you wanted. The old card is also your oldest account. Closing it shortens your history and hurts you twice. Myth 4. Bad credit is permanent. If you've messed up, it follows you forever. This is the one that keeps people from even trying, and it is not true. Most negative marks, late payments, defaults, fall off your report after 7 years. Bankruptcies after 10, and you do not have to wait for the old marks to vanish. You can start building new positive history right now. Every on-time payment today starts repairing the picture immediately. But here is the cruelest part of the whole system. The people who most need cheap credit, the ones with low incomes and thin credit files, are the ones offered the most expensive credit, which makes their situation worse. The people with strong scores and plenty of savings get the cheapest loans. It is one of the stranger feedback loops in modern finance. So what can you actually do about it? There is a short list. Number 1. Pay every bill on time. Every time. Set up autopay and remove human error from the equation. Number 2. Keep your utilization low. If you can, pay your card off before the statement date, not after. Most people do not know that the balance reported to the bureau is your statement balance, not your daily balance. Paying before that date is reported can dramatically lower your utilization, even if you still use the card normally. Number 3. Do not close old accounts. Even if you don't use the card, leave it open. Number 4. Only apply for new credit when you genuinely need it. Number 5. Check your own report regularly and dispute any errors. Mistakes happen more often than you would expect. Studies have found errors in roughly 1 in 5 credit reports. A single wrong entry can cost you points you never deserve to lose. And if you are starting from zero, no file, no history, nothing, it can feel impossible. Banks want you to have history before they will give you credit, but you can't get history without credit. There are 3 tools specifically designed to break this loop. Tool 1. A secured credit card. You put down a deposit, say $500, and that becomes your credit limit. Use it for small purchases. Pay the full balance every month. After 6 to 12 months, you have a real credit file. Tool 2. A credit builder loan. Some banks lend you a small amount, hold the money in a locked account, and report your on-time payments to the bureau. At the end, you get the money. You have been paying yourself while building credit. Tool 3. Become an authorized user on someone else's account. If a trusted family member adds you to their card, their history on that card shows up in your file. Their good habits become part of your starting point. So here is what a credit score actually is. It is not a measure of your worth. It is not a measure of your wealth. It is not a measure of how responsible you are as a person. It is a narrow statistical prediction about how likely you are to repay a debt. That is all it is. And because it is a prediction built from data, you can influence the data. Pay on time. Keep your utilization low. Let your history grow. Do those three things and the number will follow. In real life, this is the decision that matters most. Not which card to get, not which bureau to trust, not which score band you're technically in. The only thing that matters is this. Does every credit account in your life get paid in full, on time, every month? If yes, your score will eventually take care of itself. If no, nothing else you do will save it. Hit like if this one changed how you think about that number. Subscribe if you want the rest explained this clearly. And next week, compound interest, the force that quietly makes patient people wealthy and impatient people poor. It is the most powerful concept in personal finance, and almost nobody truly understands how it works. See you then.